2023 is around the corner, and people who have cash on hand want to put it to work. It's no good to have all your cash in a checking account. I mean, very safe but frozen and unable to reproduce itself. So while it's a great idea to hold a position in cash at all times, most of your money should be invested in one of the two best vehicles to get rich: the real estate market and the stock market. So in this video, I will talk about the 2023 market, how we can analyze if we are already in the bottom, stock behavior, and how you can use it to your advantage to make more money. So stay tuned. Hi there, my name is Jaime Chicaiben and I welcome you to my channel, The Foreigner in America, where I teach locals and foreigners everything they need to know about producing money, keeping money, and multiplying it, specializing in the markets and real estate. So if you're someone like myself who loves money and wants to be successful and free, please subscribe to this great channel and hit that bell so you follow up on my 2 weekly videos. Also check out my blog, Instagram, and TikTok under the same name. And take a look at my book, which I will leave a link below for you. So without further ado, let's begin. When it comes to the stock market, there are two kinds of investors out there. The aggressive ones that hate index funds and mutual funds because they want to invest in single companies to make the most amount of money. And the other ones who are risk adverse and want to invest only on safe investments like an index fund or also 401ks, IRAs, and others. But now you can find risk-free investments that pay around a 5% return. Just put your money into a high-yield savings account online and you can get close to 5%. I mean, that's really not investing, just protecting your cash against hard losses. So right now, the riskiest investments are not making investors a substantial amount of money compared to low risk or risk-free ones. And that's one indicator that the worst could be behind us when rates for risk-free investments hit 5%. Within the S&P 500, the top 20% of the stocks make up most of the growth in the index. One thing people say about index funds, which is why they don't buy them, is that you are investing on losers to get paid by the winners. While you can only go and buy stocks from the top 20 companies in the index. So companies that gave investors better than average returns usually were in the top half of their field in average market cap, cash flow, shares outstanding, and sales. These companies are the ones giving good returns to the S&P, while the bottom ones are not. And you're averaging 8% overall. Also, the price to earnings ratio should be lower to get a better return. But a lot of people don't want to invest in the market since it hasn't reached the bottom. Bold move, but stupid. Even Warren Buffett himself cannot time the market perfectly. Yes, he holds $400 billion in cash from investors and doesn't buy unless it's priced under market, but is not chasing the bottom. What people realized is that they can see several indicators on where the market could be in the bottom or very close to it and lose the least amount of money when investing hard. So these factors are the following. Number one, the US Treasury yield curve, which they say it needs to be non-inverted. How is it today? Well, it's inverted, so there's no bottom yet. The yield curve graphs the relationship between bond yields and bond maturity. As bonds with longer maturities usually carry higher risk, such bonds have higher yields than the shorter ones. A normal yield curve reflects increasing bond yields as maturity increases. The longer you hold the bond, the more money you should be paid. Number two, the CBO VIX index, which is an indicator of the expected market volatility. As a measured tool, the VIX index is expressed as a percentage, uses prices of expected options from investors. The higher, the more uncertain the market is. When the S&P 500 goes up, the VIX index is usually going down. And since it's a forward-looking indicator, investors use it as a base for a market crash or a recession. They say a VIX index of more than 45 will indicate this. Currently, we are at 22. Number 3, the put to call ratio, which is an indicator of market sentiment, is a relationship between trading S&P 500 put options and call options. So a high put to call ratio can indicate fear in the markets, while a low ratio indicates confidence. The market today is around 1.47. They say over 1.8 indicates high fear. So remember, a call is a bet that a stock will go up, and a put is for a stock to go down. Number 4, the 200-day moving average, which calculates the simple average of the closing price of a stock over the most recent 200 trading sessions. The line drawn from those numbers shows the trend of a stock over a long duration. So a stock over that line is generally on the upside. When fewer than 20% of stocks are over that line, the market is prepared to bottom. And number 5, the Buffett indicator, which is the ratio of total market capitalization of equities to GDP. In 2001, after Warren Buffett said it was a good market indicator, it became useful, as you take the total value of publicly traded stocks and divide it by the GDP. If it's 100%, it's considered fair value. But right now, it's overvalued at 160%. So whether you want to time the market perfectly or you just want to take care of your money, one thing you need to do for sure is to protect your income by keeping a healthy cash position. Let me know what your cash position is today in the comments. And do not put all your money into one single company. That's too much risk in case it drops a staggering 40%. If you buy index funds or mutual funds, you will be diversified into many sectors of the market. Just make sure you understand the commissions and fees associated with your funds. If you invest by yourself into individual stocks, make sure you buy into 10 or 20 companies that distribute dividends and are in different sectors of the market. It will be wise to use a dedicated company that has experts and specializes in the market. So 2023 is not going to be a year of gains and will not be a bull market. Everyone knows that. We're still going to be fighting inflation with rate hikes. There will be layoffs, market uncertainty, and a lot of businesses will be shutting down. This is not to depress you, but to make you aware that you need to take care of your money. Spending it all and waiting for the next paycheck or the next client to pay you back is not an option in 2023. You need to live with less than what you make and invest the rest, holding cash on hand at all times. With crisis comes opportunity. Think about it. Before the pandemic, there was no curbside grocery deliveries to your home. An opportunity was created from a crisis, and it's still working today. A lot of businesses are going cashless, another opportunity to save money. I hate it, but it saves them money. See if you can buy and sell anything online. Create value for other people through social media like this channel. Write a book, write a song, create a patent, teach something to many people. Just make sure that your job is not 100% of your life, because let me tell you something, you are most likely not going to be rich like that. I want you to succeed and be the best you can be. But remember, take control of your life and take control of your money. So thanks a lot for watching this video. If you enjoyed it and found useful information, give me a like and subscribe and hit that bell so you don't miss any one of my videos as soon as they come out. So have a great day. Don't lose any money, and I'll see you next time.